Well, hello everyone. It's Elliot Gu here with the Free Market Speculator and the Energy Bulletin, and I want to welcome you to my Sunday Deep Dive, a regular weekly feature where we take a look at a key chart, trend, or indicator that caught my eye over the past week, and I explain what it means or what I think it means for markets. Today I want to talk about a key trend within energy that's actually emerging from earnings reports and more specifically conference calls that I've listened to over the past couple of weeks. Now, of course, we're moving through first quarter earnings season here. We're actually past the peak of it for many of the energy stocks I cover. So I've been listening to a ton of energy-related calls lately and or reading call transcripts. Now, I've been doing this actually for over 2 decades now. And my favorite way to think about earnings calls is to look for what's known as read-through, or sometimes you'll hear it called read across. So basically the idea is that comments made by the management team at one company, and there are certain companies I pay extra careful attention to for looking for read across. They're companies that have a long history of making relevant statements on their conference calls about the industry as a whole. But statements from one management team at one company may have implications for a different company in the same sector or even a different sector. And as is the case with the trend I'm going to talk to you about today, the read-through may also point to a big picture or sort of a macro theme. So this simple concept of read-through is actually very powerful. It's been a key input behind some of the best market and stock-related calls I've made my entire career. And it's not just good for idea generation. It is good for idea generation, but not just for that. But it can also act as a flashing red warning sign of trouble ahead. A classic example, back in 2013 and the first half of 2014, I was listening to a number of calls from companies in different sectors within energy or subsectors within energy, and what I was hearing was a major reason that I warned readers back then to actually exit a lot of the energy names with which we generated some pretty strong gains over the years, including deep water drillers like Seadrill back then, fracturing sand companies, which were all the rage back in mid-2013. And getting out of those stocks, because of what I heard on those conference calls, actually helped us avoid much of the pain, certainly not all of the pain, but much of the pain caused by the collapse in oil prices and the bear market in energy stocks that stretched from 2014 all the way up until early 2020. It also helped us stay out of some names which looked to maybe be turning higher during that interim period between 2014 and 2020, but it was kind of a false dawn. And I credit these earnings calls and this read across strategy, if you will, for a lot of that. So today specifically, I want to talk about Halliburton's call back on the morning of Tuesday, April 21st, 2026. Now, for those of you unfamiliar with this company, they're one of the largest oil services stocks in the world, and they trade on the New York Stock Exchange under the symbol HAL, H-A-L. Now, oil services stocks don't produce actual oil and gas from wells. Instead, they're actually hired by the energy producers, both super majors like ExxonMobil and Chevron, as well as independent operators like Diamondback Energy or EOG Resources. So they're hired by these energy producers to perform work on oil and natural gas wells. So in essence, the capital spending or CapEx for the entire upstream global oil and gas production industry, well, that represents the revenue base for those services firms like HAL. Now, HAL is a global company. However, they're probably best known these days as a leader in services related to the development of shale oil and gas fields in North America, the US and Canada specifically. In particular, they're a leader in hydraulic fracturing services, related services in the United States, key fields like the Permian Basin of Texas and New Mexico. Now, I suspect many of you are familiar with hydraulic fracturing. However, just in case, here's a quick kind of basic review. Now, oil and natural gas are not found underground in some sort of a vast lake or cavern. I think a lot of people think that, it's just a lake or cavern that you just have to pump out. Rather, the oil and gas are actually found in the pores and cracks of solid reservoir rock. Now, conventional reservoirs typically have significant permeability, and that just means that the pores of the rock are connected well enough that the oil and gas can flow through the rock and into a well, powered by natural geologic pressures mainly. However, shale lacks permeability, which just means that even though there's a lot of gas and oil in the reservoir, in the shale, it can't flow through the rock and into a well because the rock is impermeable. So what hydraulic fracturing does is it's a process of pumping a liquid, mainly water, under immense pressure into the shale to artificially create permeability. So basically that just means cracks or fractures, hence the term hydraulic fracturing, in the rock, and this allows the oil and gas to flow through the shale and into a well. Now here's the key point. While it's been discussed for many years now, I've been hearing about this for at least 10 or 12 years now. International shale, by which I mean shale outside the US and Canada, it really hasn't been a thing until very recently. In other words, while shale reservoirs, geologic formations made of shale that contain oil and gas, certainly exist outside the big shale plays in the US and Canada that you've probably heard about, like the Permian Basin in Texas and New Mexico, the Louisiana Haynesville gas play, Canada's Montney shale, the Marcellus natural gas shale field in Appalachia. So these global shale fields outside of North America, they remain largely undeveloped, while the US shale has been developed very aggressively now for over 15 years. That's changing. In the first quarter, Halliburton reported 22% year-over-year revenue growth in its Latin American region. And Argentina was a standout within Latin America for growth. Let me show you a map here on your screen so you can see what I'm talking about. Specifically, the company just announced a pretty exciting development in Argentina's Vaca Muerta shale play. Now, apologies to my Spanish-speaking audience for my pronunciation. I'm way out of practice with my Spanish. But for those of you playing along at home in English, Vaca Muerta translates to dead cow in English. Long story, I won't get into it today. As you can see, the Vaca Muerta is a sizable region located in western Argentina near the border with Chile. Halliburton recently received a multi-billion dollar award, multi-billion dollar award from YPF, which is the partly state-owned national oil company in Argentina. What's crucial is that under this contract, Halliburton will deploy its advanced Zeus electric fracturing services technology for the very first time outside of North America in Argentina's Vaca Muerta shale. Now, traditionally, most fracturing pumping units, ran on diesel fuel, which can be very expensive, like right now, and it can even be tough to source in certain regions. However, Zeus is an all-electric system, which results in higher pump rates with a smaller footprint while saving on fuel costs. In many cases, operators can actually generate the electricity to power Zeus using natural gas they produce on site. Also, Zeus's all-electric technology is designed to reduce maintenance costs associated with diesel engines and also reduce downtime of the all-electric fleet relative to traditional diesel-powered fracturing equipment. Now, Halliburton reports that the technology, which is already widely deployed in the US and Canada, delivers 11% more hydraulic horsepower hours per month than traditional diesel-powered fracturing technology. And Zeus is about more than sort of raw horsepower and fuel savings. The suite of services that Halliburton bundles up with Zeus and is deploying in Argentina includes their autonomous pumping technology. So what this does is it takes input and measurements from sensors that are deployed in the reservoir itself during the hydraulic fracturing process, as well as operator data, so data from a company like YPF from prior drilling projects in the same region. And it uses that data to make autonomous decisions without human intervention about the pump rates, the pressures underground, how to change the pumping process to boost efficiency of fracturing, of the fracturing process. Now, this is an artificial intelligence technology, or AI technology. AI technologies like this are probably the hottest trend right now in North American shale. Companies like ExxonMobil and Chevron have outlined some really impressive cost reductions and efficiency improvements utilizing AI in their Permian Basin operations, as well as elsewhere around the world. And it's not just a North American story. A lot of the other services companies that I cover also talked about how AI is really taking off in global conventional oil fields. You know, YPF is the first international shale field of its size, but it's being deployed in conventional oil fields around the world as well. The fact that YPF is contracting with Halliburton to use this Zeus technology outside the US, well, that's a clear signal that the Vaca Muerta shale field is reaching a key inflection point in terms of development, one that no other international shale play has met in recent years. It's moving from an ancillary play, sort of 3 years ago even, to one of the most exciting unconventional stories anywhere in the world. So let's zoom out a little bit. Argentina has experienced an energy renaissance in recent years, and you can see it on this chart. This chart actually shows Argentina's oil production divided into production from conventional oil fields. Now that's the blue area of this chart. And the so-called unconventional fields, the orange region, from January 2009 through November of 2025. Now, unconventional in this case, it's basically just a synonym for shale, and in Argentina's case, the Vaca Muerta shale play specifically. Now, as you can see, conventional oil production in Argentina has been in decline for many years now due to the maturity of their main fields. Now, that's the natural decline from older conventional oil fields that have been in production for many decades now, since the 60s in some cases. Now that's the decline you're seeing in the blue area of this chart. However, unconventional production, almost entirely from Vaca Muerta, produced using these modern hydraulic fracturing techniques, well, that's exploded since 2021-2022. Indeed, total production reached around 850,000 barrels a day for Argentina as a whole in the month of November 2025. And that's up from around 660 to 670,000 barrels a day just 2 years ago in late 2022. Now, specifically, the breakdown of that more than 250,000 barrels of growth from shale production, which was actually offset by a more than 50,000 barrel a day decline in conventional oil output from Argentina, over that same just 2-year time period. Now, Vaca Muerta now accounts for approximately 68% of Argentina's total oil production, up from next to nothing 4 or 5 years ago, and 56% of its natural gas output. Natural gas output's actually growing even faster, and there's some exciting developments on the way there as well, which I'll talk about here in a minute. This year, Argentina's oil production is expected to top 1 million barrels a day, on average, growing to as much as 1.5 million barrels a day by the early 2030s, all supported by growth in the Vaca Muerta shale play. A key component of this renaissance has been what's known in the industry anyway as an above-ground change or reform. So Hal talked about this quite a bit on the call. In this case, in Argentina's case, that's tax, incentives, legal reforms undertaken by the government of Javier Milei to make Argentina more attractive and less risky from an investment standpoint. All designed, of course, to attract foreign capital into Argentina. Look, I won't detail all the many, many changes Milei has made in recent years. However, here are a couple of standouts. Back in 2024, I think it was over the summer, Argentina passed its Régimen de Incentivo para Grandes Inversiones. Again, sorry for pronunciation there. It's a landmark piece of legislation, and let's just call it by its acronym, shall we? It's RIGI, or RIGI. Now, RIGI applies to projects with a minimum value of 200 million US dollars. And what it does is it offers a 30-year guarantee of stability, investment stability. The list of benefits include that RIGI reduces the corporate tax rate from the normal 35% rate in Argentina to just 25%. You get total exemption from import duties for capital goods and spare parts, which used to be a big problem there. The elimination of export duties after just 3 years of project compliance, no export duties at all. Provisions to allow foreign investors to keep their hard currency earnings outside Argentina. Argentina used to use capital controls to try to trap money generated from projects in Argentina there. International arbitration rights, allowing investors to settle disputes in neutral international forums, arbitration forums, rather than Argentina's own domestic courts, which, again, was a big problem previously because Argentina's domestic courts, frankly, were not seen as impartial, to put it mildly. Now, RIGI has also implemented a series of reforms that help make it difficult and very expensive for a future Argentinian government, one less market-friendly than Javier Milei, to undo these reforms and this investment stability. The list includes international arbitration clauses that I just outlined, okay, as well as what's known as a provincial adhesion doctrine, which basically means that deals would need to be overturned at the provincial level or changed at the provincial level as well as at the national level. That makes it more difficult because individual provinces in Argentina would be less amenable potentially to changes in Argentina laws regarding investment than the national government if the national government were to change into a less market-friendly government in future. Now, Javier Milei just did win a major mandate late last year, but it is helpful to have these guarantees or items to make it difficult for changes to be made to RIGI in there. So also under the terms of the RIGI deals, an investor is granted a property right, and this is very important, which under Argentina's constitution makes it far more difficult for a future government to overturn without granting the investor a significant sum of money to compensate them for the assets that they have. You see, before Milei, it was almost impossible to imagine a foreign services company like Halliburton agreeing to a multi-billion-dollar contract with YPF to deploy its most advanced fracturing technology and AI systems in Argentina. So far overall, this law has attracted more than $69 billion, and again, it's only been in place for less than 2 years now, worth of investments into Argentina, including investments to build pipelines serving the Vaca Muerta Shale, an LNG export facility that's designed to export gas produced from this shale field abroad in the form of LNG. And most recently, I believe February of this year, February 2026, the law was actually expanded to upstream projects as well. And that means not just infrastructure projects like pipelines or LNG facilities or gas processing facilities, but actual drilling and production projects. And there's more than RIGI. Milei's government has also amended a 1967 Argentina hydrocarbons law to prioritize maximizing profits and exports over what was previously called domestic supply security. Basically, this eliminated the government's power to block exports in an effort to keep local prices low. A famous trick from prior Argentinian governments. Milei also replaced political appointees of the country's national oil company, and again, that's YPF, with industry veterans, people who actually know what they're doing and know something about energy markets. That wasn't common previously. In this case, the YPF led by CEO Horacio Marin, who launched his plan 4x4. Some of the changes he's enacted include selling off 55 mature, low-margin conventional oil and gas producing blocks to free up $1 billion US dollars for investment. He also reallocated 80% of YPF's $6 billion annual budget exclusively to the Vaca Muerta shale. As I said earlier, the fact that this is a large contract and that it's the first time Halliburton's most advanced shale production technologies are being deployed in an international market outside North America signals the fact that Vaca Muerta is moving into what we call manufacturing mode. So what that means is producers there have clearly transitioned from delineating the play and evaluating its productivity to actually trying to boost production and Argentina's oil and natural gas exports. Now let me give you 3 Argentinian energy companies. They're all traded here in the United States to keep an eye on. None of these are specific recommendations I'm making in any of the services right now. But I am planning a deeper dive into Argentina for a future issue of the service focused on the Vaca Muerta shale. So the first one is YPF Sociedad Anónima. The symbol there is YPF. Vista Energy, symbol is VIST, V-I-S-T. And Pampa Energia, which symbol there is PAM. These are all traded on the New York Stock Exchange. So here's a chart of the NYSE traded ADRs for YPF. That's the national oil company. It's a weekly chart so you can get a good idea of the longer term trends. As I said, YPF is the national oil company in Argentina, and the state, actually the federal and provincial state governments, hold a golden share consisting of a 51% combined stake in the company. This company holds the largest acreage position in the heart of the Vaca Muerta play. And it's also a major investor in the largest export and infrastructure projects. Now that gives them both upstream and midstream exposure to the VM shale. Next up, Vista Energy. As I said, trading on the NYSE under the symbol VIST. Vista Energy is the second largest shale producer in Argentina, which has around 150,000 net acres to YPF's 3 million plus. So it's essentially the high beta play on Vaca Muerta. It's a fast-growing independent E&P, exploration production company in Vaca Muerta, while YPF is more the large integrated producer or major producer. Now, like many US shale fields, the Vaca Muerta has an oil-rich window that produces mainly crude oil or mostly crude oil, a gas-rich window that produces mainly natural gas. This would be the deeper portion of the play. And a wet gas window. What that means is that natural gas and natural gas liquids and usually some oil are the main production there, but you get a lot of natural gas liquids like ethane, propane, butane, etc. Now, Vista Energy's much smaller acreage is concentrated in the oil-rich window of the play. So that is an advantage. Now, Pampa Energia trades on the NYSE under the symbol PAM, P-A-M. So Pampa, it's mainly known as an electric power utility in Argentina. However, it has undergone a dramatic transformation over just the past couple of years, enabled to a significant degree by the Malay reforms I outlined, particularly that RIGI law. The company purchased acreage in the Vaca Muerta from Petrobras, entering the upstream portion of the play in what's known as Rincon de Aranda block. Okay, so PAM recently leveraged Malay's RIGI framework to move ahead with a central processing facility there designed to process 45,000 barrels per day of oil from Vaca Muerta. PAM also has a 50% stake in the TGS pipeline and associated industrial hubs. This is all designed to process natural gas, separating the natural gas liquids, and ultimately exporting gas in the form of LNG. So let's broaden out this theme even a bit more. In prior issues and videos, now I've discussed the massive Stabroek block offshore Guyana that ExxonMobil is developing along with Chevron now actually. Now this is one of the most exciting oil and gas finds of the century, and no, I'm not exaggerating. Of course, I have also discussed the situation in Venezuela, especially after Nicolas Maduro was removed early this year. Brazil also has some major developments underway in its deepwater offshore fields. And I'd also point to Suriname, which is here, next to Guyana, and which was known up until 1975 as Dutch Guyana. That 1975 is when they got their independence from the Netherlands. Now, offshore Block 58 in Suriname is a deep water play being developed as an oil field, with the first oil targeted for mid-2028 and upwards of 250,000 barrels a day of potential production there. Now, Block 52 in Suriname, that's a sizable natural gas find. It hasn't gotten its final investment decision yet, but it could be out as soon as later this year. And this would likely be developed for LNG exports from Suriname. So Suriname is an exciting emerging play as well. It is located just adjacent to Guyana, and actually there is some continuity in the resource structure between what's found in Guyana and what's found in Suriname, geologically. These are conventional deep water fields. And of course, Latin America is also rich in other natural resources like copper, iron ore, precious metals, silver and gold, and even agricultural commodities like soybeans. Brazil, a major producer of soybeans. So not all countries in Latin America enjoy the same above ground political advantages that Argentina has with Milei. However, regional markets have generally been performing quite well, stock markets. This chart shows an ETF tracking Latin American equity markets. Now, it is totally dominated by Brazil and Mexico, nothing from Argentina, actually. But we're tracking it here with this ETF since the end of 2020. Now, that's the blue line. The red and green lines show the relative strength of this ETF against the MSCI Emerging Markets Index and the S&P 500, respectively. As you can see, Latin America has been broadly outperforming both the S&P 500 and other emerging markets since December of 2024. And I think part of that is due to the fact that it's a sort of resource sanctuary, if you will. It has significant natural resources, as I just outlined, and it's located far away from the current conflicts in the Middle East. So that's my Sunday deep dive for this week, and I hope you enjoyed it. Please drop me a like if you enjoyed it, and feel free to comment below this video. This coming week, I'm planning to release a deeper dive into the oil services industry for Energy Bulletin, as I believe select stocks in this group will be among the biggest beneficiaries of any de-escalation we see in the current situation in the Middle East. In fact, I think they're going to benefit one way or the other, and they've already started to. So if you're a paid tier reader to the Free Market Speculator and Energy Bulletin, be on the lookout for that report. And if you're not yet a paid tier reader and you'd like to get all my alerts, updates, and model portfolio recommendations, I am offering a 30-day free trial this month for new subscribers. You can click the link below to join us and see if our approach is right for your portfolio. Thanks again for listening.